Good morning. My name is Nick Gait, Investment Director here at Tideway Investment Partners. Welcome to another installation of Tideway's Meet the Manager series. With me here today we have Martin Shenfield, Managing Director of Global Strategy at TS Lombard. Martin has 34 years of industry experience in fund management, as well as CIO and asset allocation responsibilities. Martin joined TS Lombard in October 2014 to promote and communicate the firm's macroeconomic and strategy views, and since 2020 has helped with Tideway's asset allocation and investment committee decisions. Good morning, Martin, and thank you for taking the time today.
Good morning, Nick, and thank you for having me on this webinar.
Hopefully that introduction was broadly accurate, and now is your opportunity to correct me and perhaps expand on that initial introduction.
No, that was accurate. I had spent nearly 34 years overseeing global asset allocation, mainly for big US ERISA funds and endowments, when I came out of retirement to join TS Lombard nearly 8 years ago. At the same time, a large part of my career has been spent managing Asia Pacific, long-only institutional mandates, mutual funds, and hedge funds for nearly 20 odd years. And that happily led along the way to me spending time in Hong Kong, where back in 1981, a long time ago, I helped set up Fidelity's first Asia ex-Japan operations, the wild bull market in Japan in the 1980s, and more recently Singapore. And it's also during those times I pioneered launching various dedicated country funds, such as in Taiwan, Thailand, and Indonesia. So it's been a broad and varied and very interesting investment career.
Yeah. What was the most interesting point in that long career of yours?
Well, of course, now helping you support your clients. But leaving that aside, I think going back to the wild 1980s in Taiwan and Japan, in extraordinary bull markets, where everyone in society was involved punting wildly, including Buddhist monks. And that's when I critically learnt the importance of technical analysis to complement the fundamentals.
Perfect. So you mentioned Tideway being one of the highlights of your career.
Of course.
Can you perhaps explain the services you currently offer to Tideway?
Well, Trusted Sources, or TSL, essentially we advise investment managers and asset allocators, including the biggest global institutions, as well as regional wealth managers and family offices. At the same time, private equity firms, corporates, and even central banks subscribe to our research services because we have a different qualitative approach and an analytical framework. And we hope that's value added and complements the traditional sell-side research.
Perfect. And in terms of obviously a wide breadth of clients there, can you describe briefly your role on Tideway's investment committee and what exactly you bring to the table, how you add to our process?
My role is firstly to communicate in timely fashion TS Lombard's global macro views, investment strategy, and asset allocation recommendations. And I think as importantly, to engage in robust discussion with yourself and your colleagues to stress test these views as well as yours, and hopefully to give you the context and confidence when you then come ultimately to construct your various investment portfolios.
Talking about markets, can you summarise what you think you've seen in 2022 so far with inflation and where we go from here?
Well, I think we have to give some context because really since the post-GFC low in May 2009, we have been consistently strategically bullish on US dollar assets, equities, bonds, hard assets, pretty much everything, even allowing along the way for shorter term tactical risk-off periods, which we've tried to flag up. But finally, we turned cyclically negative at the end of last year, beginning of this year, on pretty much everything except the US dollar and energy. But I would characterize the bear market so far as an old-fashioned traditional one. That is to say, the Fed got too far behind the curve, has had to chase to get back on top of inflation, and that's led to the rapid interest rate hikes we've seen, and both equities and bonds as a result have corrected sharply. But against that, I think we have to understand that in most DM economies, both corporates and households, leaving aside the mortgage sector, remain broadly underleveraged, given the post-GFC clear out of bad debts. And this is especially true in the US, and why we remain so strategically bullish for all this time until the end of last year. So I think the key point is we're not facing a systemic financial crisis like the GFC. And even the emerging market economies have so far proven remarkably resilient given the strength of the dollar. But of course, given the latter and the recent sharp interest rate hikes, we're going to start to see some individual financial accidents, and some of these are now appearing. I think the only similarity to previous recent bear markets is perhaps the dot-com boom, in the sense that because we had too many years of unnecessary QE, this obviously created a valuation bubble in the growth part of the equity market, and that's now being somewhat painfully, but longer term healthily unwound.
So the last time we had double-digit inflation and an energy crisis was in the 1970s, and stagflation. Similarly, the response was in Volcker's regime, I believe, to hike rates aggressively. Are there any outcomes we can draw from that which may help us see what the future holds here?
Again, I don't think we expect a simple return to the 1970s, when for several years the world experienced double-digit inflation and negative real interest rates. For one, Labour and unions simply don't have the same bargaining power, although critically their share of corporate profits is now set to increase. And also, we're already seeing within energy and commodity markets a response to higher prices in terms of new supply being brought forward. In the short term, we think the Fed may still be a bit more hawkish than the consensus expects, and we think you're likely to see a 75 beeps rate hike in December. But that will probably represent, in market sentiment terms, peak hawkishness. And next year, after maybe one more hike, the Fed is likely to start easing. And we need to remember that the Fed, unlike the ECB, has a dual mandate, both inflation and growth. And the key point is, if the Fed was really to attempt to get inflation back to its arbitrary 2% target, it would have to put the Fed funds rate somewhere between 6 to 9%. And that would precipitate a politically unacceptable hard recession. Now, it doesn't mean the Fed might not make a policy error and be too tight, but we don't think that would be what it would wish to achieve. So once the Fed sees the unemployment rate at 4.5% and rising, we think essentially it will capitulate and accept long-term inflation at 3% plus, a new era of higher inflation. So we've been arguing strongly, even before the recent big moves, that US 10-year Treasury yields at 4% plus actually had begun to offer very good long-term risk-reward value, along selectively with US investment grade. But I think the key point is the Volcker-inspired 40-year one-way bull market in bonds is clearly over, and in future, essentially, they're going to range trade.
Okay, understood. No, thank you very much for that. Yeah, so moving on to what this means, essentially. So, picking up there, I believe we're heading into a period of structurally higher inflation, higher income, higher yields, and lower valuation. And I know your colleague Dario Perkins espouses this as one of his core arguments. Do you agree with this view?
Yes, of course I have to, although we do have very robust internal debates. But essentially what Dario is arguing is for a new macro supercycle. And simply all that means is the next 5 to 10 years, certainly in market terms, are going to look very different from the post-GFC era, the so-called Great Moderation, where we had long periods of zero interest rates and enormous QE. So in future we're going to see, and we already are, deglobalization and supply chain reconfiguration, particularly characterized by US-China decoupling and re-onshoring. We're also going to have to face the short-term costs of decarbonization and labour taking a greater share of corporate profits from capital, and all against a backdrop of bigger budget deficits and fiscal policy predominance. And if you add all that up, basically, given my previous comments about the Fed, it means we're going to operate in a new era of higher embedded core inflation. In the context of the US, as I said, more like with a 3 handle than a 2. What does that mean? It probably also means more volatile markets, and with that higher core inflation, a higher range for bond yields and therefore higher discount rates, and ex ante that means broadly lower price earnings ratios. But we're still going to get cyclical bull markets, but they're going to be driven by earnings growth rather than by multiple expansion. So I think, in conclusion, from an asset allocation point of view, we're going to have to be more nimble, at times a bit more tactical, and from a longer term perspective, build much more diversified portfolios rather than just relying on growth momentum stocks, which is really all you needed in the last few years.
Yeah, so touching on that, the last 10 years or so post global financial crisis, the old balanced 60-40 portfolios work very well. Would you say that this strategy is still viable, or will this come under pressure in the future?
Well, clearly this year it's not worked for the first time in a very long time, 20 odd years, and that's made it difficult for everyone. I think the conclusion is it will at times, but we're going to have periods where we have, as we've had this year, so-called counter-cyclical inflation, which is cost push, which is very negative for both equities and bonds. And then we may flip back to more pro-cyclical inflation, as we would characterize it, where that 60-40 model worked well. And I think we've just begun a small phase of that again. Mm-hmm. But I think this gets back to the challenge that we're going to have to be more tactical and more nimble. There'll be times when it works and times when perhaps it doesn't.
Okay, thank you. On a positive note, through this market turmoil, is there a sector or an asset class which will think will work a lot better in this new macro super cycle, if you had to pick one? I know you've just outlined there the more nimble portfolios and so forth.
Well, going back to Dario's new macro super cycle thesis, he would emphasize a greater connection to the real economy and tangible assets rather than intangibles, which is characterized by the FANG stocks. And I think as a broad theme that makes sense. So clearly there are growth areas like the renewables and green energy generally. Infrastructure is going to play a bigger part. I think defense is going to play a bigger part, for all those are obvious. But also areas like financials, healthcare, industrials and capital goods, which have broadly not been at the center of performance for the last few years. And within that, as going back to your 60-40 question, I think there'll be times when what's broadly characterized as value will work. And I think in the long run, you need more of a value tilt. But there are also going to be periods when growth at a reasonable price will work. But the key is your entry valuation point. You're going to have to be much more selective and judicious about what you pay up for growth, again, compared to the last 5 years. And lastly, going back to your question about Volcker slaying the 70s bond market or bear market and inflation, I think you'll need some commodities and real asset as ballast in your portfolio as a diversifier. So it comes back to the same conclusion, a more broadly diversified portfolio.
Perfect. So I know markets have reacted quite bullishly in the last couple of days towards the end of last week with regards to the inflation figures coming in lower than expected, and perhaps expecting only a 50 bip rate hike rather than the 75. This is an example of is this an example of an off consensus view, or if not, do you have another off consensus view that TS Lombard currently hold that you could share with us?
Well, I think the consensus has caught up with our key off consensus view, which was at the end of last year and beginning of this, to be much, much more hawkish about the Fed. And Steve Blitz, our US economist, has called this brilliantly over the last few years. If we went back to the end of last year when the consensus for the terminal rate was about 3.5 or lower, he had a figure more like 4.5. Post the August negative CPI surprise, the market moved up initially to 4. He was already at 5.5. Right now, the market has almost got up to 4.95. So I would say the market consensus has got much closer to us on Fed hawkishness. And in fact, we're saying probably the December hike is peak Fed hawkishness, unless inflation really does continue to surprise negatively. I think where we're different from the market next year is that Steve expects once the Fed does start to ease, and the timing of that is the key unknowable at the moment, then they'll ease more aggressively than the market currently prices in. The second area where we have a very unique proprietary analytical approach, as you know, is China. Now, for some years, we've been arguing that for traditional Chinese manufacturer and exporters, they have become increasingly uncompetitive because the renminbi was too expensive. Now, obviously, it's drifted this year, which will mitigate some of that. But the other part of our caution on China, growth anyhow, is that the traditional money multiplier or credit multiplier has become progressively impaired. And this has become even more damaged with the property crunch we've seen this year, which is severely constraining household propensity to invest, spend, take risk, and so on. So right now in China, I think our view is we're still below consensus on growth. There's going to be a turn coming as they relax on zero COVID, and you'll get 2 or 3 quarters of what looks like traditional high growth in China, but you want to fade that because the underlying dynamics have turned much more negative. So we think probably trend growth in China long term is more like 2.5, 3, not the 4, 5, 6 that one used to see. Having said that, like the US, it's an enormous stock pickers market. So you can always find something, particularly in the policy preferred sectors within the domestic A-share market, where you can make both relative and absolute returns.
So, no, thank you for all that, Martin. That was, very, very detailed responses there. One final question, which I'm sure our UK-based clients will be, very eager to hear your response on. Don't worry, we won't hold you to it. But what's your, with rising rates, obviously we saw briefly during Truss's reign, yields came under significant pressure to the upside, and there was significant worry for the relatively short duration UK housing market. With that in mind, what is your view on where UK house prices perhaps go in the next year or so as those variable rates come off, as the fixed rates come off?
Well, I started my investment career as an analyst covering, amongst other things, the property market or the property stocks way back 40 odd years ago. But as you know, property is always local, so it's hard to generalise even across the whole of the UK. But if we looked at London and the South East, and again, I think we'd have to take the very top end out of this because that's a parallel universe where you have huge cash buyers from overseas who will look at sterling and think it's cheap. So if you're out in Asia with a closet dollar base, UK assets now look cheap, but they're going to be operating probably more at the top end of the market. I think simplistically, given where rates are likely to go with mortgages, a simple model would suggest a downside of 10 to 15% plus. However, what we've traditionally seen in UK housing market corrections is probably only a grind down of sort of 10% and then a long period of flatlining, where perhaps you're losing in real terms, but in nominal not much is happening. So I think it's a messy outcome rather than a catastrophic one, but we have to see.
Yeah, let's see if that holds true. Again, Martin, thank you very much for taking the time today to speak to Tideway, and looking forward to seeing you at our next investment committee.
Thank you for having me on today.